In Canada, the landscape of property ownership has shifted. Owning residential property may now require filing a separate federal tax return, even if no tax is actually owed. This new requirement has caught many property owners by surprise, leading to questions about who needs to report and what the potential consequences are for missing a deadline. It's no longer just about your annual income tax. There's now a specific focus on how residential space is being utilized across the entire country. The Underused Housing Tax, or UHT, was introduced to address housing supply issues by targeting residential properties that are considered vacant or underused. In most cases, this is a 1% annual tax on the value of residential property held by affected owners who do not meet certain exemption criteria. The goal is to ensure that housing is made available for residents, rather than sitting idle in a market with extremely high demand. This is a federal requirement, meaning it applies consistently across all provinces and territories for those who fall under its legislative scope. Some property owners must file an annual underused housing tax return to declare their residential property status to the CRA every single year. The filing deadline is generally April 30th of the following calendar year, matching the standard tax season timeline we are all familiar with. You can file your return electronically through the CRA's My Business Account portal or submit a paper return if that is your preference for your records. The first step is determining if you are an affected owner. If you are, the filing is mandatory, even if you qualify for a full tax exemption. Exemptions exist for properties that are a primary residence or for those undergoing major renovations or occupied by qualified tenants. However, you must still file the Form UHT 2900 to claim these exemptions and prove that no tax is actually payable on the property. Specific exemptions also apply to vacation properties in certain rural or remote areas, but verifying your property's eligibility through the official CRA tool is essential. This is where many people make mistakes. Assuming that zero tax owed means no paperwork is a risky assumption that can lead to significant trouble. Certain property owners, including private corporations, partnerships, and trustees, have mandatory reporting obligations under the UHT rules. Even a small family-owned corporation that holds a rental property is considered an affected owner and must file annually without exception. Failing to file the required return can result in significant penalties. For individuals, the minimum penalty starts at $5,000. For corporations, the stakes are even higher, with a minimum penalty of $10,000 for each property that was not reported. Stay ahead of the curve and ensure your properties are correctly reported. Follow us for clear Canadian tax insights and stay compliant in 2026. Thank you for watching.